Nobody likes losing money in the stock market, but I'll tell you what, I really love selling puts. So sometimes I actually like the down days. That's what I'm going to talk about in today's video. I'm going to go into selling puts, the advantages to it, and what I really love about this strategy. Hello, my YouTube friends. My name is Adam Kahn, and this is Investing with Adam K. Hope everybody's having a good Friday. I hope you got some fun plans for the weekend. I hope you're going to get to spend some time with some family because that's really what's important in life. So, why do I love selling puts? What do I see it as an advantage for? And why does that mean that sometimes I like down days? I know that sounds stupid because the reality is nobody really likes down days. All those people who talk about I love red days or whatever else, they're full of it. We all want to see our accounts go higher. The interesting thing is one of the things I noticed, a lot of the people who talk about 80% returns, 100% returns, and I'm going to make you $1 million. It's kind of interesting how their videos slow down when the markets retrace or pull back. That's kind of why I say be really careful about the people you follow and the things they're talking about, because if we ever get a real correction where the market has a long-term trend downwards, they're going to see themselves in a rough position. It's very hard to imagine that they'll be able to sustain the strategies they're using. Buying the leaps, leveraging your positions, these are all dangerous things to do, and they work great when the market's going higher. So everybody looks like a genius in a bull market, even guys like me, which is kind of cool. Even I can look good in a bull market. Anyway, why do I like selling puts? How does that work? What's the advantage? Why are people talking about it? This is a really great strategy. Now, as a little asterisk and be careful type of thing, there's risk in all sorts of investments. And there are ways you can lose money selling puts unless your goal is to buy a stock that you want to own. So the first thing you need to do when you're looking to buy puts is focus on a company you actually want to own and look at a price where you actually want to buy it. You do not want to sell a put on something that you're going to be unhappy if you end up buying, and you sure don't want to end up overpaying simply because you're trying to collect a premium from selling a put. The second thing after recognizing the stock that you want to buy is making sure that you have the cash funds to be able to afford 100 shares of that stock, because each option contract accounts for 100 shares of a stock. It is not one share, so be very careful with it. But let's say, for example, you love Amazon. Now, I don't know if you saw yesterday's video, but I really dove into Amazon. I think today it even looks more attractive. This is not financial advice. I'll do my little thing at the end so that you can hear the spiel about, you know, need to do your own research and that stuff. But I think Amazon has gotten to a really attractive level. Now, let's say you don't think so, or you're still nervous that the market's going to continue to fall, and you would like to buy Amazon, but you want to pay $230 a share. So you'd think to put your order in, you go to work, so you leave a resting, maybe a 60-day good till cancel order, buying Amazon at $230. So that's the type of scenario where I like to implement the strategy of selling a put. And this is why. You can get paid money to put that order in, right? Like, that sounds pretty weird. And let me explain puts and how they work before we talk about selling, because sometimes going backwards, people get really confused. So a put is an option, and it's an option to be able to sell a stock if you're buying that option at a certain strike price. Most people use it like insurance. So in the opposite scenario, somebody who owns Amazon might be nervous that it's going to continue to fall, so they might buy some puts in order to protect their position. What does that do? That gives them the right to sell the stock at the strike price on a given date. So maybe they go a month out, they buy the 230 puts against their stock that they're long, giving them the right to sell that stock at the $230 strike price a month out if that's the date when it expired. So if they're using that to be able to sell the stock, somebody who sells the put would in turn have to buy the stock. So that's kind of why I say it's a really good strategy to use to actually get into a position. So out of curiosity, I went and took a look at what next month's $230 put in Amazon December 5th date strike price of 230 was trading at. Now, my wife made me go shopping with her. When I looked earlier, it was $4 and like 30 cents. But right now, as Amazon's rallied a little bit, it was $3.40 bid. Now, I just went with the bid because if you were selling the option, that's probably where you're going to get filled, if not a little bit better. So if you sold one of those options at 340, you get $340 for that option. In some ways, and other people talk about it, that is free money. It isn't free money. There's risk associated with it. There's nobody just handing out free stuff. But to be fair, if you were planning on buying the stock at $230 anyway, and you were going to put a good till cancel order in, you may as well get paid to have that resting order in some respects. So this would commit you to buying 230 shares, 100 shares, forgive me, of Amazon at $230 on December 5th if the stock is trading below $230. Now, your only risk is it trades below that $230 and then goes back up, and you don't end up buying the shares. And I'll explain that because I know some people in the comment section may say there's other risks associated with it. Now, you get to keep that $340 no matter what happens. So if Amazon just continues higher and never gets to your level of $230, well, you get $340, whereas if you just put that resting order in, you get nothing. So it's kind of like getting paid to make a commitment to buy those shares. Now, why do I say the only risk is that the stock goes below your strike price and then back up and you never end up buying the shares? Well, the difference is if you had left your resting order, obviously if the stock goes below 230 anytime between now and December 5th, you would be filled, you'd own your 100 shares. In terms of the put, the only way you're most likely going to get filled is if it is below that price on expiration. Anything it does in the meantime, if it goes below and above and below and above, you're not buying those shares until December 5th. You still get to keep the $340. And I know somebody in the section is going to say, but if Amazon craps out and it's trading $150 a share, well, you've lost all that money. Well, the reason I said the only risk is it goes below it and back up is because if you were going to put your order in to buy it there anyway, you would have taken on the same risk. It's not that I don't recognize the risk associated with selling puts. It's that if that was your plan, you may as well get the additional funds because there's twofold to that. A, you're getting an extra $340. B, if Amazon doesn't get quite down there and it's trading at right where it is in a month, well, you have the opportunity to do that again, and maybe you get another $340, or depending on volatility, whatever you would get paid to do that again. If the stock goes a little bit higher, maybe you could collect another $1 or $2 or whatever the amount is where the option is trading at. You could even go further out in the timeline, so like pick a later date if you want to get more of a premium. So main risk is the stock goes below the price, then back up, and you don't end up buying your shares. If you do, if on December 5th it is trading below that $230 strike price, you will end up receiving the 100 shares on the following Monday that you can then do whatever you want. Now, I personally, in something that I'm trading and using the strategy in, I might turn around and sell calls in my set it and forget it account. The only reason I don't use the put selling strategy is the company I do it with, they don't allow put selling. So otherwise I really would. I think it is the greatest strategy in the world. I think it creates your discipline to pick the level of where you want to get into a stock and stick with it. The other risk is that you're somebody who's always trying to hit home runs. You do it too big, a stock moves and goes down a good bit, and now you're stuck buying a bunch of shares you really didn't intend to. That's why I say you really have to think it through and make a decision of the stocks you want to own, the price you want to own them at, and then kind of look at an options chart and see the time frame where it makes sense to maybe sell a put. As a side, there are two things you'll want to pay attention to if you decide to try to implement this strategy. One, you're going to want to pay attention to when earnings are. And two, you're going to want to pay attention to a dividend if the stock has a dividend. And here are the reasons on those. If you're looking at a stock and it's during earnings season and they have an earnings report, the premium is going to be higher than you might expect it to be because of the volatility when earnings come out. I hope that's actually pretty obvious. I hope there's a recognition of when earnings come out, the stock can really move a good bit, and you should get paid more for the risk you're taking on that something comes out could be pretty negative and the stock could go further to the downside than you expect. Could go further to the upside as well. Also, both reasons why you should get a higher premium. Why did I say you should also pay attention to a dividend? Well, if you're selling puts in a company that has a dividend, on the ex-dividend date, the stock should fall by the dollar amount of the dividend. Now, with Amazon, it doesn't matter. They don't pay a dividend. But I've talked in other videos about doing it in some pretty boring stocks like Conagra and Verizon and the like. And I think it's a phenomenal strategy for these. I've been having very good success trading some super boring stocks, picking up what looks like pennies in these dividend stocks. But boy, the pennies really add up. And it's a way to increase, like when I look at a stock, and I've talked about this in other videos, and I'll try not to spend too much time on it. But when I look at a stock like Conagra, and maybe you hate Conagra, maybe you don't care, maybe you don't pay attention to it. But if I'm buying Conagra, odds are I'm buying it because I want that 7% dividend that it pays. Well, if I can pick up an extra 3 or 4% selling options, that pushes it from 7% to 10 or 11. The amazing thing with a stock like Conagra that's as boring as hell, as far as I'm concerned, doesn't go very far, is if I make 15 cents a month, that's an extra 9% a year. And when I tell you how easy it is to get 15 cents on Conagra in a month's time frame, it really is. And I've been selling puts and calls, and I've been getting 15 cents on both ends of it. And I think over a year's time, I'm going to take a 7% dividend paying stock, and I'm probably going to end up making between 20 and 30%, which blows my mind away on a stock that just, in my mind, really doesn't go anywhere. I do recognize the risk. It could continue to drift lower. But when I paid attention and started adding up how much I've collected from selling the calls and selling the puts versus the stock that I've been getting assigned as it's been drifting lower, and it's been drifting lower. I'm down money on the principal, and if you look at it, it looks like I'm losing money. But man, I've made almost all of that back. I have a really nice position, and I'm short a whole bunch of calls about from the stock that I've gotten assigned. So anyway, the reason you pay attention to the dividend is the stock should fall the amount that the dividend is on the ex-dividend date. For example, in Conagra, they pay a 35-cent dividend. So if it's trading $17.20 on the week that the dividend gets paid, technically it's below $17, even though it isn't already. So when you're looking at something like a $17 put, and all of a sudden it's getting a bunch of money that you didn't expect, because the professionals are accounting for the dividend that it's going to pay during that week, which should make the stock price drop. So if you're looking at selling puts in a dividend stock, really pay attention to when that ex-dividend date is so you don't get caught off guard and all of a sudden get assigned shares that you didn't expect because they pay out that dividend. Again, also pay attention to when they do their announcement for their earnings, because that's going to add some volatility, which you might love because you should get paid more for the option. If you're willing to buy the stock anyway, you're getting paid more, and if it falls, so be it. You would have bought it. As always, this is not financial advice. Please don't listen to me. Anything I share in these videos are just entertainment purposes only. You need to reach out to your financial advisor when making your financial decisions. And not only should you not listen to me, I don't think you should be listening to anybody on YouTube for these decisions. There's a lot of people out there giving some terrible advice. I find it pretty interesting. I might have mentioned it earlier, but I got distracted when I went out shopping with my wife for a while. But all of a sudden, when the market starts correcting, their videos seem to disappear. It tells you a lot about who you're watching and the information they're giving and if it's good information. The ones that are here for the long run accept their losers and accept their winners and understand that markets go up and down. There's a lot of people who give some great advice on YouTube as well. But be really cautious the ones selling how to make $50,000 in a month or how to get 80% returns, and then they sell their course, which by all means, if you would like to get into my course, I think I'll charge like $1 million for a year, and maybe you'll get to chat with me twice. If somebody's willing to pay that, I'd be happy to start a course. But obviously, I'm joking. But I was watching one person in particular who talks about how I'm not going to even mention whether it's he or she, makes 80% a year, 100% a year, and you can sign up for their course. And I think they're charging $5,000 to sign up to their course. And my guess is they sell you on nothing. They teach you how to sell calls, they teach you how to sell puts. When I've listened to the videos and watched about some of the people that are having success, the successes, it seems like nonsense. Anyway, as always, not financial advice. Please do your own research. Don't listen to me um, when making your own financial decisions. If you haven't already, do me a favor, hit that subscribe button, smash the like button, make some comments in the comment section. Hopefully your account had a nice rebound the way that the market did and you ended up today. The markets have been really scary, so I completely understand that. Um, I said to my brother that it's interesting, even on the up days, I don't like how much the market's moving. I'm a boring, slow and steady, the tortoise and the hare type of guy. So seeing the big moves in the up direction and the down direction, I don't like that volatility for the most part. It's also why I have a set it and forget it account that I don't really watch so that I don't worry about it too much. But in the trading account, whoa, all over the place. If you have any questions on selling puts or selling options or trading options, by all means, put it in the comment section. Don't forget, Tuesday at 11 o'clock, I'm going to do another live. It would be great if you're able to make it 11 a.m. Pacific time. I get it. People work. You may not make it. It may be a terrible time. Just fits my schedule because that's really all that matters because I'm super selfish. Anyway, again, have a great weekend. Spend some time with the family. Let me know if you have any travel plans. Lance, I hope you're on vacation. I hope you guys are having fun, and I hope when you get back, I get to hear all about it. Have a great day. Bye bye, guys and girls.